You're now listening to the Supply Chain Secrets Podcast, the ultimate insider's guide for all things ocean shipping. Brought to you by Kaishax, helping you deliver through volatility.
Hi, everyone. You're listening to the Supply Chain Secrets Podcast. I'm your co-host, Caroline Weaver, and with me is Lars Jensen. Lars, how's it going?
Going great. I'm still in my home office, so 2 weeks in a row being at home, but I'm off for Canada tomorrow.
Perhaps a record. Well, let's get started talking about rates as usual. I will share my screen, and let's go ahead and talk about the Asia to US West Coast, Asia to US East Coast rates.
Yeah, because if we look at the rate developments, the overall headline for the Pacific rates is they're flatlining compared at least to last week. We've seen a steady, slow increase here over the last couple of months, but overall, it's a flat line. There isn't much change. The only exception to that, and that's basically the one we called last week. Remember, for a few weeks, we've been talking about especially the Northeast Asia rates, how they seem to weave around the underlying trend. And given that they weave around, we predicted for the US West Coast rates that they should be coming down again. And lo and behold, that is exactly what they did. That doesn't mean that Northeast Asia to US West Coast are, let's say in quotation marks, really coming down. It just shows that we have this sine wave going around the other main trades. So the headline, the true reflection of the market is right now the Pacific has been flatlining compared to last week.
You know, it's nice having that predictability, at least, with one very specific thing. Let's take a look at the futures. So for Asia and North Europe, let's take a look at where the rates are at this week.
Yes, I mean, if you look at Asia, North Europe, the actual spot rate itself also essentially flatlined there. It has been coming down here over recent weeks. We had first a tiny peak when the Hormuz crisis erupted. That peak rapidly evaporated to the point where the carriers are basically not getting fully compensated for the increased fuel prices. It now flatlined. The interesting part that we're looking at here is what are the indications for the freight futures going forward and how has that changed? And I find that interesting to look at because we are slowly approaching peak season. If you look at the last couple of years, especially in Asia and North Europe, peak season tends to come 2 to 4 weeks earlier than we're used to, simply because of the extended sailing time all the way around Africa. So it is imminent. And if we look at it, especially for July, what we see here is an increase compared to last week. And we've been talking about this in recent weeks. It has actually been slowly creeping up over the last 3 to 4 weeks in terms of what the future markets anticipate for the peak. And did so this week as well. So now we're at a point where the peak that we are looking at in July is at a level about $900 higher than where we are now, give and take. So that's an indication of at least what the participants out in the futures market right now are considering to be the most realistic outcome. So sure, rates have been coming down on Asia, Europe in recent weeks, but all indications right now are that peak season is just around the corner and peak season is about $900 up, which is roughly about 45% up compared to where we are right now.
All right. And let's take a look at the Asia US West Coast rates as well.
Yeah, for the Asia US West Coast, this is slightly different. I mean, we haven't had the rate decline on Asia US West Coast that we've seen on Asia North Europe. Actually, we had a slow, steady increase over the last couple of months. We just had the flatlining this week that we just talked about. But if we look at the futures rate, I think what the market has done is it's probably more reflective now also of more normal seasonality. For a few weeks, we've sort of had a forward curve that was showing slow, steady increases all the way out to October, November, which would be quite odd compared to normal seasonality. And that's actually changed this week. So what we're seeing now is also an expectation of a more normal seasonal pattern, again with a peak happening in July commensurate with the usual peak season. However, the increase from the current level until that peak is not as much of a difference as what we saw in Asia Europe. Keep in mind on Asia Europe, we were looking at a $900 per 40-foot jump from now until July. On Asia US West Coast, and actually it's about the same if we were to look at US East Coast, it's a $300 jump per 40-foot compared to where we are now, reflecting that rates have actually been creeping up here over the last couple of months. Still an increase compared to where we are now, but not as massively so as what the expectation is for Asia to North Europe.
Yeah. All right. Interesting stuff. Thanks for walking us through that. Let's shift gears a little bit and talk about the latest on tariffs. So we've been getting some more news in the tariff realm lately. What's the latest as of this week?
Yeah, the latest is there was a case run by the U.S. Court of International Trade on the so-called Section 122 tariffs. And I'm sure by now everybody's getting completely confused as to the very, very, very many different types of tariffs. So let's not get hung up on details. But it's a 10% that were the retaliation because the EBIT tariffs were ruled illegal. And as far as I am aware at this point, the technicality is it's only the plaintiffs right now that are then allowed to get a refund on these tariffs, and where the U.S. administration is instructed not to charge them this tariff. Of course, that would have to be a precedent for everything else. The U.S. administration have predictably then appealed it, so this has to go through an appeals process as well. We had a statement from Trump in the wake of this, basically saying, then we'll do it in some other way. And sorry to say, but for all the U.S. importers, this must, to some degree, feel like you are trapped in the old movie Groundhog Day. Because we see first the institution of tariffs, then the tariffs are ruled illegal, then other tariffs are put in, then they are ruled illegal, and the solution is now to put in other tariffs. And we, by the way, also have the Section 232 tariffs that are going to go away in July. That is also going to be replaced. So for all the U.S. importers, there appears to be no real outlook of a stable trading and predictable trading environment thus far.
Yeah. Well, you're still paying some of these tariffs. Like you mentioned, it's only the plaintiffs that they're not having to pay the tariffs. But for the other importers, it does bode well potentially for you. You might at least be compensated for some of that tariff money that you've been paying.
And of course, as many of the consumers have found out, which is not surprising at all, the tariffs go back to the importing companies, but they do not go to the consumers that might have paid through higher retail prices.
Yeah, definitely a bummer if you ask me. Well, let's talk a little bit about the Strait of Hormuz now. So we had a few incidents last week. Can you talk about that?
Yeah, basically the situation is not improving. Since we spoke last week, we have had 2 attacks. We had one attack last week on a CMA CGM container vessel. It was actually hit on the bridge. You had, sadly, 8 seafarers that sustained injuries, but apparently not severely so. If you rummage around on social media, on YouTube, you can actually find a video taken by one of the sailors on board the bridge showing the extent of some of the damage that was on board. Then we had another attack yesterday on Sunday, which was a bulk vessel, just 20 nautical miles away from Qatar. And for those unfamiliar with the geography of the Persian Gulf, Qatar is a very, very long way away from the Strait of Hormuz, deep inside the Persian Gulf. So this was not a vessel that was trying to transit, not even by a long shot. It was very far away. What is also part and parcel of this story is it has a sister vessel, a tanker that was attacked early in the conflict all the way up by Iraq. And the main common denominator appears to be that they have a managing company, which is a U.S. company. So this seems to suggest that the Iranians are both willing and capable, also now under the ceasefire conditions, to potentially shoot either drones or missiles at vessels that they see in any way, shape or form linked to the U.S. And maybe to add to that, we had the extremely short-lived U.S. Operation Freedom, which was touted as being able to then give military protection for a lot of vessels to get out. Very, very few vessels managed to get out, one of them being a U.S.-flagged car carrier actually operated on the Ferrol, which is part of Maersk Line Limited. So technically, you can say it's a Maersk vessel that made it out. But apart from that, Operation Freedom was quickly shut down again and is no more. So we are back to the situation as it has been now for a couple of months, where de facto, the Strait of Hormuz is shut completely. The vessels we see pass through are typically vessels where the shipping lines are saying, fine, we'll run the risk to get the vessel out of there. We're not really seeing anybody saying we want to ship cargo in there. It's a matter of getting the vessels out.
Yeah, which is definitely a troublesome situation for the people that live and rely on those cargo vessels to be delivering necessities to them. One question that I had for you in regards to freight rates, are we seeing risk priced into rates at this point? Do you think there's still room for the rates to increase, or do you feel like it's covered at this point?
Yeah, I'm not sure I would call it risk being priced in. I might look at it in a slightly different way. I mean, if you look at spot rates from, say, China into Dubai, they are at least 4 to 5 times higher now than pre-crisis. Is that risk being priced in? I wouldn't say so, because the cargo is also not being routed through the Strait of Hormuz. It's being routed overland via the ports in the Gulf of Oman or in the Red Sea. So you're really paying the premium for a completely different routing. A risk pricing, at least from my perspective, would be if there was somebody willing to pay for cargo to go on a ship and run the risk of actually going through the Strait of Hormuz. And from that perspective, there's nobody, at least now, willing to pay a price that is so high that the shipping lines and their seafarers are willing to run the risk of actually using the Strait of Hormuz.
Yeah, which is definitely a reflection of how dangerous the situation is right now.
Yes.
All right. Well, thanks for that update. We'll, of course, share more as the week progresses in our episode next week. Let's talk about the demand data that was released for March. What was the findings there?
Yeah, I mean, that is interesting. Keep in mind the container trade statistics that provide the best global demand data out there always measure at time of loading. And for March, that of course means the entire month was also the first month of the Hormuz crisis.
Right.
And if we look just at global demand measured in TEU, global demand was down year on year by 2.4%. That was a massive change to what we have seen the last 2 years. The last 2 years, global demand has essentially been hovering between typically 5 and 8% growth. So a drop down to minus 2.4% is a huge shock. However, it's also instructive to then try to drill into why is that? And it turns out this is not widespread global decline, not by a long shot. It can be explained by two and only two factors: US trade war and the Strait of Hormuz. The US trade war, that is not new. We have been discussing that at various parts before, which is impacting US volumes. North American imports in March, again year on year, are down 8.4%. That's a massive drop. Exports are down 3.5%. So that's part of why the global numbers were pulled down. In the Hormuz crisis, the first few weeks of the Hormuz crisis, all the carriers simply stopped booking acceptance into the Persian Gulf, which means that nothing into the Gulf was loaded at all. So of course that has a major impact.
Right.
It should be said that the data from container trade statistics at a regional level is not just the Persian Gulf. It's what they call Middle East India subcontinent. So it also includes cargo to the Indian subcontinent. It also includes cargo to Red Sea ports. So it's not just the Persian Gulf. But basically what we see there is imports to that wider region is down 25%. And exports are down almost 30%. So this is, of course, clearly the closure of the Persian Gulf impacting that. We should expect this downfall to be somewhat less for April and going forward, because this is where carriers again started with some levels of booking acceptance for some of the overland movements. It will still be negative, but not as much. So what I then took to say, okay, if global demand is down 2.4%, but what does it look like if we look at the world without North America and without the Middle East India subcontinent, so everything that is not impacted by the US trade war and not impacted by Hormuz? What does it then look like? And in that case, the rest of the world was still up 5.4%. So still within this 5 to 8% growth range that we've seen the last couple of years. We can certainly have a fear or a concern that the Hormuz crisis will eventually slide us into a deeper global financial crisis because of higher energy costs and supply chain problems. But for now, at least in the March data, that is not the case. The rest of the world keeps on trucking just nicely.
Yeah, that's good to hear, because some of these numbers are quite astounding. I mean, imports being down 25%, that's very noteworthy.
It is, but I mean, let's again keep in mind what happened in those first few weeks after the Persian crisis began was just every carrier not just saying no to booking acceptance, but also discharging Gulf-bound cargo in whatever random port was the next port that they were getting to.
Right. It's almost surprising that it's not even higher than that of a number. All right. Well, let's wrap up today's episode talking about the Maersk Q1 results. So what were the findings there?
Yeah, Maersk came out with their Q1 results. They did very well on the volume basis. They actually grew their market share a little bit. Rate-wise, of course, rates are down. That's the case for the market as well. Maersk's rates declined basically in line with market. So from that perspective, rates in line with market, growing market share, sounds overall positive. What I also noted, though, was this was now the second consecutive quarter in which Maersk had a negative EBIT level. If we think back to Q4, if I look at the 10 largest carriers that do provide results, this top 10 does not include MSC. Amongst those top 10, 4 had negative EBIT earnings in Q4. Maersk was one of them, so they also had it in Q1. And the one that we also know now is O&E. O&E was also negative in Q4, but O&E actually managed to pull that back up to a positive here in Q1. So that's definitely a weak point on the data that came out from Maersk here in Q1.
And does this tell us anything about the underlying health of the ocean carriers at this point?
No, that would be premature. It definitely tells us that Maersk is having some challenges. But again, keep in mind from Q4, Maersk was also at the lower end of the performance segment of the top 10. Whether that will be the case remains to some degree to be seen. But I would see it as maybe a slightly worrying sign that when O&E is able to pull back up to positive, why was Maersk not?
All right. Well, thank you, Lars, for all the updates this week. Anything else that you want to add, or good to wrap up?
No, I think that we are basically all good to wrap up, and let's see what the coming week is going to bring us.
Awesome. Thank you, everyone, for tuning in. We mentioned last week that there is a survey that we have released. We want to hear from you all on what you like, what you don't like about the podcast. So the survey, you can find the link on LinkedIn, or you can go to tinyurl.com/supplychainsecrets26, no spaces, and let us know what you think. But until then, if you haven't subscribed already, please do that. We are on YouTube, Spotify, and Apple Music, and we will be back next Monday. Cheers, everyone.
Thanks for listening to the Supply Chain Secrets podcast, presented by NiceX. Be sure to subscribe on your favorite podcast app.